Stop what you're doing right now. Seriously, put the phone down, close the tabs, pause the noise. Because what's unfolding this Monday morning, April 13th, 2026, isn't just another market headline, another oil scare, or another war story. It's something bigger. It's the slow, deliberate cracking apart of the entire monetary system that's run the world for the last 80 years. And almost no one is connecting the dots. I'm just an ordinary Asian guy sitting here watching the same screens you are. Right now, silver is trading at $73.57 an ounce as I record this. Gold is sitting at $4,712. Both are down this morning, silver off about $2.20, gold lower by roughly $35.20. The headlines will scream about tankers, naval formations, and the Strait of Hormuz. They're not lying. But they're only telling you half the story, and that half is dangerously incomplete. The real battle isn't about barrels of oil. It's about who controls the pipes those barrels flow through, and more importantly, which currency you're forced to use to buy them. That single question, which currency, is exactly why silver is moving the way it is today. It's why gold has been on a 3-week tear that only just paused. And it's why every Gulf state, every European finance minister, and every treasury desk in Asia has been quietly dreading the next few days. The first real test is coming within the week. When it lands, the precious metals market will never look the same again. Let me be direct with you before we go any deeper. What I'm about to walk you through isn't the kind of analysis you'll hear on financial television or read in the big papers. Those outlets are laser focused on the military angle because that's what gets clicks and keeps people glued to the screen. They're not talking about the monetary architecture because explaining that requires a level of historical and systemic understanding most financial journalists simply aren't trained for. I've been studying this exact intersection, the petrodollar mechanics, reserve currency status, and the role of precious metals, since around 2017. I've watched the slow shift away from dollar dependency the way you watch a supertanker change course in the open ocean. It doesn't turn on a dime. It takes years. But once that turn is complete, the wake it leaves behind reshapes every coastline it touches. That turn is finishing right now. And today's price action in silver and gold is one of the first visible ripples on the surface of something happening 6,000 feet below the waterline. Stick with me. By the time we're done, you'll understand why the announcement about the Strait of Hormuz wasn't really aimed at Iran. It was aimed squarely at China. And why that single distinction changes everything about where silver, and the entire global financial order, goes from here. Let's reframe the whole situation with two recent statements from President Trump. Taken separately, they sound like standard geopolitical tough talk. Put them side by side, and the picture that emerges has almost nothing to do with Iran's nuclear program. Statement 1. The United States Navy will blockade every vessel entering or exiting the Strait of Hormuz. Full stop. No ship paying tribute to Iran gets through international waters. Statement 2. Let China send its tankers to us, or to Venezuela. We've got plenty of oil, and we'll sell it cheaper. Now here's the number the mainstream coverage conveniently buried. Between 80 and 90% of Iran's oil exports go straight to China. Almost every single vessel that Statement 1 is designed to stop is headed for a Chinese port. Trump says, Iran. But the real target is China's most important non-dollar energy lifeline. This isn't accidental. This is the point. For years China has been buying that Iranian oil and paying for it in yuan, not dollars. No SWIFT system. No US banks. No way for Washington to freeze the transaction or turn the tap off at will. The deal settles in Chinese currency, sometimes routed through crypto, or even gold via the Shanghai Gold Exchange. Iran gets paid in a form that never touches the US financial system. That quiet arrangement has been one of the biggest ongoing acts of de-dollarization happening in plain sight. Trump's blockade isn't military pressure on Tehran. It's a direct demand to Beijing: buy your oil from us, use our system, and step back inside dollar dependency. Because the second China starts routing purchases through American or Venezuelan channels, it re-enters SWIFT, it uses dollars, and it once again becomes vulnerable to the exact same sanctions weapon the US has used on Russia, on Iran, on anyone who steps out of line. Freeze assets. Restrict access. Strangle supply. Washington can flip the switch whenever it wants. China understands this perfectly. And China is not going to walk back into that cage voluntarily. That's where the stakes stop being theoretical and become existential, not just for the two superpowers, but for the entire global monetary order and for every single person holding physical silver or gold. Right now, the blockade forces a binary choice. Either it works or it doesn't. There is no comfortable middle ground. Either Chinese merchant ships are stopped by the US Navy in international waters, or they sail through untouched. Each outcome carries consequences that dwarf anything happening in the Iranian nuclear talks. If the US actually stops a Chinese vessel, Beijing won't answer with a press conference. China will respond by accelerating its sales of US treasuries. It will deepen its naval presence in the region. It will pour even more resources into building yuan-based payment rails right inside the strait itself. And it will pull the rare earth card hard. China controls roughly 75% of global rare earth exports, and the United States imports about 80% of its annual needs. That leverage doesn't vanish during a naval standoff, it becomes sharper. Meanwhile, U.S. Treasury yields, the 10-year already hovering near 4.34%, the 30-year pushing 4.93%, would face selling pressure that makes today's levels look tame. Foreign central banks holding those bonds as reserves would start asking the question they've been whispering for 3 years. Why are we still holding these? If the issuer of the world's reserve currency is using its military to enforce financial obedience, then those bonds aren't safe assets anymore. They're political weapons. And political weapons get dumped when the politics turn hostile. If the blockade fails, if Chinese ships sail through and the US Navy stands aside, the damage to dollar credibility is immediate and catastrophic. Every Gulf nation watching, Saudi Arabia, the UAE, Qatar, Bahrain, Kuwait, will draw the same conclusion: the American security umbrella is theater. The protection guarantee is no longer credible. My sources in the region tell me those countries are already acting on that realization. They're continuing to sell U.S. treasuries. They're buying physical gold and silver. They're quietly taking equity stakes in mining operations. This repositioning isn't theoretical. It's active, and it's accelerating. Either way, blockade success or blockade failure, the path leads to dollar weakness. The only question left is how fast it happens. Let's go one layer deeper, because without this context, today's price action in silver and gold looks like random noise. With it, it looks like the opening chord of a historic shift. Meanwhile, U.S. Treasury yields, the 10-year already hovering near 4.34%, the 30-year pushing 4.93%, would face selling pressure that makes today's levels look tame. Foreign central banks holding those bonds as reserves would start asking the question they've been whispering for 3 years. Why are we still holding these? If the issuer of the world's reserve currency is using its military to enforce financial obedience, then those bonds aren't safe assets anymore. They're political weapons. And political weapons get dumped when the politics turn hostile. If the blockade fails, if Chinese ships sail through and the US Navy stands aside, the damage to dollar credibility is immediate and catastrophic. Every Gulf nation watching, Saudi Arabia, the UAE, Qatar, Bahrain, Kuwait, will draw the same conclusion: the American security umbrella is theater. The protection guarantee is no longer credible. My sources in the region tell me those countries are already acting on that realization. They're continuing to sell U.S. treasuries. They're buying physical gold and silver. They're quietly taking equity stakes in mining operations. This repositioning isn't theoretical. It's active, and it's accelerating. Either way, blockade success or blockade failure, the path leads to dollar weakness. The only question left is how fast it happens. Let's go one layer deeper, because without this context, today's price action in silver and gold looks like random noise. With it, it looks like the opening chord of a historic shift. The reason this confrontation exists at all traces back to a structural trap that's been building since 1971, when the United States took the dollar off the gold standard. Economists call it Triffin's dilemma. Here's the plain English version. Any country whose currency is the world's reserve must run persistent trade deficits. Why? Because the rest of the planet needs dollars to trade with each other. To supply those dollars, the reserve issuer has to export them, by importing more goods than it exports. That hollows out domestic industry, piles up debt, and ships manufacturing capacity to lower-cost competitors. Every previous reserve currency empire ran the same playbook: the Portuguese, the Spanish, the Dutch, the British. The British pound's era effectively ended in 1956 when London could not enforce its claim over the Suez Canal and had to back down under American pressure. The cost of keeping the system running finally exceeded the issuer's capacity to sustain it. The United States has been sitting at that exact inflection point for years. What's happening in the Strait of Hormuz right now isn't the cause of the crisis. It's the symptom of a system that has already eaten itself from the inside out. China saw this reality clearly during the 2008 global financial crisis. At the time, China was a huge creditor to the US, holding enormous volumes of treasuries. It helped stabilize the system, then spent the next 17 years methodically reducing that exposure from about 29% of foreign-held treasuries down to roughly 7.3% today. At the same time, China has been buying gold for 17 straight months, with each purchase larger than the last. The Shanghai Gold Exchange exists precisely so yuan holders can convert their currency into physical gold without ever touching a dollar-denominated instrument. Iran's toll system in the Strait, collecting fees in yuan or crypto, with gold settlement available through Shanghai, isn't some improvised workaround. It's the operational endpoint of infrastructure built over a decade. The Iranian parliament formally legalized it in March 2026. And here's the part that should make your jaw drop: even Japan, one of America's closest allies, holding roughly $1 trillion in U.S. treasuries, has already used that system. Japan paid the yuan-denominated toll just to keep its tankers moving. When a treaty ally of the United States is paying in yuan to transit a waterway that used to be under unchallenged American protection, the petrodollar architecture isn't under pressure. It is already partially collapsed. Now let's connect all of this directly to silver, because silver is not a passive spectator in currency wars. It is one of the biggest winners when those wars reach their climax, and we are approaching that climax. Every major reserve currency transition in history has been accompanied by a powerful surge in gold and silver prices when measured in the outgoing currency. As confidence in the old reserve erodes, sophisticated capital flees to assets that live outside the system entirely. Assets that cannot be sanctioned, cannot be frozen, and carry zero counterparty risk. Physical silver is one of those assets. Physical gold is the other. The sovereign wealth funds in the Gulf who are selling treasuries and stacking both metals right now understand something that many retail investors in the West are only starting to wake up to. When the system finally resets, the assets that survive are the ones whose value doesn't depend on any government's promise. Silver at $73.57 today is not expensive. It is not at a peak. It is sitting at the exact moment when the fundamental logic for owning it has never been clearer to the biggest, most sophisticated pools of capital on Earth at the same time. The sell-off this morning, silver touching a session low of $74.24 before bouncing back, gold swinging more than $100 overnight, is not a crack in the thesis. It's exactly what always happens at moments of genuine geopolitical escalation. Oil spikes, fear sweeps the tape, risk-off selling hits everything at once. WTI crude near $96.50 this morning is a classic fear signal, and fear produces indiscriminate liquidation. Traders dump gold, dump silver, raise cash, and run to whatever they think is safe. But here's the key word: perceived safety. The US dollar itself is the very instrument whose credibility is being tested by the blockade announcement. A flight to dollars during a dollar confidence crisis is, by definition, temporary. When that flight reverses, it reverses hard. Gold touched $4,637 in spot trading before recovering to $4,736 by London Open. Silver bottomed near $72.50 before climbing back over $2. These aren't random wiggles. They are the violent breathing of a market trying to process an event it has never seen in its modern form, a direct challenge by a nuclear-armed economic superpower to the military enforcement mechanism of the petrodollar system. The industrial demand story for silver remains rock solid and completely separate from the monetary story. Solar manufacturing is consuming silver at record rates. AI data center build-outs need enormous quantities of it. Electric vehicles aren't slowing down. Mine supply isn't ramping fast enough to meet any of that. Those fundamentals are locked in no matter what happens in the strait. But the monetary case, the case for silver as a neutral store of value outside a weaponized reserve currency, just received the most public, televised confirmation it has ever had. Portugal lost its spice trade routes. The Dutch lost control of key sea lanes to Britain. Britain's own moment of truth came at Suez in 1956 when it tried to retake the canal and was forced to stand down. That event didn't instantly kill sterling's reserve status, but it confirmed what smart money had already concluded: Britain could no longer enforce its claims. The slow exit from the pound accelerated. Gold priced in pounds began its long climb as the currency weakened. Substitute the Strait of Hormuz for Suez. Substitute the dollar for the pound. Substitute China and its growing network of partners for the coalition that pressured Britain in 1956. The rhyme isn't perfect, history never is, but the structural logic is identical. A superpower that cannot enforce its claim over a vital trade artery has already begun the transition from primary to secondary status. Assets denominated in the declining currency, U.S. Treasuries, begin a long repricing lower. Assets outside the system, physical gold and physical silver, begin a long repricing higher. The question every serious precious metals holder should be asking right now isn't whether silver goes higher. The structural forces make that outcome far more probable than any alternative. The real question is whether you are positioned to ride out the violent volatility that always accompanies these transitions. Because transitions are never smooth. They are brutal. The 1970s move away from Bretton Woods saw gold climb from $35 to $850 an ounce, but not before it dropped 47% in the middle of the bull market. The path is ugly even when the destination is certain. So here's the practical framework I'm watching over the next 72 hours. These aren't abstract ideas. They're concrete signals with real consequences. First, Chinese naval positioning. If Beijing moves warships toward the Hormuz region, it is signaling it will not accept the blockade passively. That message alone will push gold and silver higher as dollar all. Second, Treasury yields. The 10-year near 4.34% and 30-year near 4.93% are already at levels that historically choke economic growth. Any further spike, especially the 10-year pushing toward 4.5% or higher, almost certainly means foreign holders are selling. That selling is the most direct, real-time bullish signal you can see for silver and gold. Third, the premium on the Shanghai Gold Exchange versus the London FIX. When that premium widens, it tells you Chinese institutions are demanding physical gold faster than Western